Declines in the value of your stock portfolio can be a really stressful time for a lot of people, and frankly, it's a time where decision making becomes oftentimes a really emotional process for a lot of investors. It's the kind of situation where, to be frank, the average everyday investor who historically hasn't got that good of returns from picking individual stocks is separated from some of the most rational and best long-term investors in the world. I would hazard a guess that the average investor would really prefer if their stock market just steadily trucked up and up and up over time, yet some of the best investors out there, like Warren Buffett, actually really like stock market declines because it can provide great opportunities to buy undervalued good businesses and generate even better long-term returns. Now, to me, the decline that we've seen in 2022 is really not anything crazy looking historically. It's certainly no 2008, 2009, or 1970s, or 1929, or anything like that. But I think it's a good time to revisit some rules that you should probably have in place to think as rationally as possible. So in this video, I want to cover 3 things that I'm doing during this period of declining stock prices to help me think rationally, to help me make better decisions, and to hopefully improve my long-term returns as an investor. If you enjoy this video, be sure to subscribe to the channel if you haven't already. That way you can see future content as soon as I release it here on YouTube. And thank you to everyone who has been subscribing to the channel. We're coming up on about 40,000 subscribers, which is a cool milestone to reach, and I really appreciate the support. Now, the first of these 3 things that I'm doing as stock prices decline is simply to remember one of the oldest rules in the book from Benjamin Graham, obviously the author of The Intelligent Investor, and the guy who basically taught Warren Buffett a lot of the fundamentals behind value investing. And that is that a stock is not just a piece of paper or, I guess, an electronic thing in your brokerage account these days. It's not just a piece of paper, it is ownership in a real business. And that means that we really shouldn't be focused on what stock prices are doing. Rather, we should really be focused on what the underlying businesses are doing. And if there's sort of a disconnect between what the business is doing and what the price is doing, that could create an opportunity for us as investors to either buy or sell a particular stock. Now, I want to use 2 practical examples of companies that I follow here, and this is not intended to be recommendations of any sort. But just to give you a couple of practical examples, I want to talk about Berkshire Hathaway and a company I follow closely called Thor Industries, which is a RV wholesaler for anyone that hasn't heard me talk about Thor a million times on the channel here before. Now, both of these companies actually have fairly lumpy earnings, so even paying attention to the business results can be a little tricky from time to time. In terms of stock price, Berkshire tends to be a historically pretty stable kind of stock of the market. It's not super volatile. Thor definitely is a little more volatile, but just to give you some examples of what I mean in terms of paying attention to the business rather than the stock, I want to look at the book value for both of these companies. Both companies, although they have pretty bumpy earnings, kind of quarter to quarter and year to year, have had pretty steady growth in their book value. The book value and the return that book value is generating, aka the return on equity, is something I pay pretty close attention to with a lot of businesses, particularly Thor Industries. And book value growth was the main kind of yardstick that Warren Buffett actually used at Berkshire for a long time as well. So just to share kind of the disconnect between market value and business performance that can sometimes happen in stocks, let's look at, say, the book value growth for these 2 companies relative to the market value growth or the change in stock price over the past 5 years. Now, if we look back 5 years for Thor Industries, Thor was trading at a really kind of high stock price, and if you had purchased kind of exactly 5 years ago as of recording this video, you would actually be down about 40%. But if we look at the underlying book value for Thor, the book value has grown about 130% in the past 5 years. And the quality of that equity, the quality of that book value still seems to be about the same, if not even a little better for Thor. They're still earning, over the long run, about 20% returns on equity. So that big disconnect between a decline in stock price and a growth in book value and still good quality book value is really just a big change in market sentiment. 5 years ago, investors were paying like 4 times book value for Thor, whereas they're paying a little more than 1 times book value today. If we then look at something like Berkshire Hathaway, over the past 5 years, the stock is up about 45%, and the book value growth, the book value is up about 54%, so a much tighter relationship with that particular company. So it goes to show that kind of anything can happen in markets, and there can often be big disconnects in terms of stocks being overvalued relative to their business results and undervalued relative to their business results. And it truly is the underlying business that we should be focusing on initially to understand whether something should be bought or sold, or whether it's a good kind of investment opportunity. Now, the second thing I'm doing as stocks decline is simply reviewing my watch list. I, for a long time, have had a list of companies that I am either invested in or that I would be invested in if the price got low enough. Businesses I really like and I think I understand, but they just have never really been cheap enough for me to get invested in. And really here, all I am doing is just kind of putting in the groundwork again, refreshing myself on what's been happening with these underlying businesses. A lot of them may be companies that have been on my watch list for 1 or 2 or 3 or 4 years, and it's certainly possible that I haven't really done a deep dive on these companies in a long period of time. So that's something that I'm doing. I really want to understand whether I think this is still a good business, or it's still, deeply undervalued if it was more of a lower quality kind of 50-cent dollar type investment. So I really want to understand where that company stands currently in terms of valuation. And I also want to actually overlay some of the things that are going on in the broader economy at the moment. Now, if you've listened to basically any value investor ever, they will always tell you to focus on the micro rather than the macro, or in other words, focus on the underlying individual business as opposed to trying to predict what the Federal Reserve will do or what interest rates are going to be or anything like that. But investor Lee Lu also tells us that when things in the macro environment, I guess, get extreme, we should probably pay at least some attention. And what I mean by that is I'm really trying to put those individual businesses and put the micro kind of in the context of the broader macroeconomic environment. So just to give you, again, a couple of examples of that, I am invested in a company called Seritage Growth Properties, again, not intended to be a stock tip or anything like that, but Seritage are currently going through, or it looks like they're probably going to go through a process of liquidating all of their real estate investments and paying out the cash to shareholders. Now, a pretty significant component of that is going to be how much can they sell these properties for, and we currently have an increasing interest rate environment. We probably haven't seen a huge impact on real estate, commercial real estate prices yet, but it is certainly something that could happen. So the question that I'm asking myself is the investment thesis with something like Seritage Growth Properties permanently impaired? And with a kind of longer term hold, greater business, I'm trying to, again, understand, is the potential headwind that they may be going through just something short term, which creates a long-term opportunity for a long-term minded investor, or is the situation permanently impaired due to, some sort of macro condition? If it's truly a great business like a Apple or a Microsoft or Amazon or something like that, it's probably pretty unlikely that those businesses won't be around in 10 years just because interest rates are going up or something. But you want to put all the businesses in your watch list through that thought process and certainly understand where their valuations sit today as well. Now, if you're looking for new companies to potentially add to your watch list, I always like to start by following some of the best investors in the world, and the best investor out there is obviously Warren Buffett at Berkshire Hathaway. And if you want to see kind of a curated list of the top 5 companies that Warren Buffett has been buying in 2022, actually put together by me, then check out the first link in the description below. That will take you over to Simply Wall Street, where you will see those top 5 companies. You'll see some metrics on the underlying businesses, as we've talked about earlier in this video. That's what we want to pay attention to. And you'll also see a bit of commentary from me around why I think Warren Buffett might be buying into those companies. If you're also interested in using the Simply Wall Street platform, that link will actually get you a 40% discount on the unlimited plan. So thank you to Simply Wall Street for sponsoring the channel, and thank you to people who have taken up that option so far as well. It directly supports the channel, so thank you for that. Now, the third and final thing I'm doing is actually creating a very structured plan in terms of what I will do if particular stock prices go down. And this is basically, again, just to make good decisions, remain rational, and kind of execute my intended plan when I hopefully get the opportunity to do so. And I've seen this countless times before where people will say, let's just say a stock's trading at $200 a share, and they might say something like, well, if it ever gets to $150 a share, I'm definitely going to buy that stock. And then what you often see is maybe the stock drifts down and down and down, and it's getting close to 150, maybe it's at 160, for example, and then they'll now start saying, I really want to buy this stock. I think I'm going to wait till it gets to maybe $130 a share, then it'll be cheap enough. And so people are constantly kind of changing their thought process. They had a business that they thought was going to be a great long-term investment at 150, and now just because there's been a price decline, they're saying, well, maybe it's going to go a little bit lower, and maybe I'm better waiting till it gets to 130. Sometimes I even see people say things like, well, it's down to 150, but there's a Federal Reserve meeting tomorrow, and I think interest rates might go up, and then they start getting very macro and getting away from, again, the underlying business and the valuation and the price that you can kind of buy that business for. So that is not a trap that I want to fall into, and for that reason I have actually a very structured plan with a few different companies that are on my watch list. And it might actually surprise some people as to how detailed that plan is, but I definitely would recommend putting something together for yourself to help you remain rational. And basically what that plan says is, at this stock price for this company, I will put exactly this many dollars into that stock. And if it goes a little bit lower and it gets to this price, I will put exactly this amount of money into the stock. And if it goes down a third time, again, if it gets to this price, I will put exactly this amount of money into that stock. For me, that is a really nice structured way to just set up a good plan and execute it, and hopefully have the long-term results kind of take care of themselves. I find that a lot of people are fearful about buying into a stock because they think it might go lower. And oftentimes I think there's a couple of different explanations for that. Frankly, some people just do not have the right temperament to be long-term owners of stocks. And if that's you, there's no problem with that at all. Maybe you're better investing in some other vehicle, but that often is sort of the culprit. The other thing is that potentially you're investing money that you might need in a relatively short space of time. And that's something that I definitely avoid doing. I am not investing money in stocks that I need within the next 5, 10, and maybe even more years. So I am really, structurally kind of set up to be able to ride out any bumps in the road that might happen in my portfolio. The other positive thing around having a very structured buying plan with a particular stock for me is another trap that I've seen people fall into is they can tend to average down over and over and over and over again into a particular company. And at a certain point, there are some definite pros to being diversified in your portfolio to a certain extent. And the last thing that you want to do is average down and average down and average down and keep buying into a stock to where it's like 50% of your portfolio, and then you actually turn out to be wrong with your investment thesis about that company and you lose a whole bunch of money. That is a terrible situation. And again, having a very structured buying plan will greatly help you in avoiding that trap. So I hope you enjoyed that video and me kind of laying out a few of the things that I'm focusing on as stocks continue to decline. If I had a choice between stocks steadily rising forever and stocks being super volatile and us getting these, big upswings and big downturns from time to time, I would definitely go for the volatile markets. Warren Buffett and Ben Graham and countless others have written many times that your long-term returns will be pretty heavily influenced by just how many opportunities you get to buy great businesses at cheap prices. And if we have more volatile markets over time, we will get more opportunities to buy at really depressed prices and, sell high, right? The very basics of investing, buying low and selling high. So those are the things I've got in place to hopefully remain rational and make the best decisions I can through more volatile markets. And I do hope you enjoyed it. But that's it from me for this one, and I'll see you in the next video. Cheers.